Welcome to the BizDev podcast. I'm your host, Edwin Fisher. In this episode, we get to talk about something that I like and hate at the same time, or I like learning about taxes, income taxes. We have our guest, Tyler Bennett from getataxlawyer.com. He goes over a lot of different things. I mean, he talks about a story, how he came from the Midwest, moved out to LA, started a firm in his mid 20s with 100 people, a CPA tax advisor firm. And yeah, he kind of talks a lot of different things, like, generally how you can save on your taxes if you're a W-2 9-to-5 employee. He also talks about different things coming up in the tax game regarding crypto and how you need to be reporting your gains in crypto, and kind of how there's different benefits and tax savings using crypto. Overall, this was a great episode. I really enjoyed it. I like nerding out about taxes. I hope you do too. So make sure to like, subscribe, comment, let me know your thoughts of this episode, and enjoy it. Welcome to the BizDev podcast. I'm super excited. We have a great topic today, taxes. Tyler Bennett is our guest, founder of getataxlawyer.com. We're going to go over a lot of different things, like big ideas of taxes, what's the most benefit way to, save on taxes. And I'm super excited. Tyler, thank you so much for coming on.
Absolutely.
Yeah.
Glad to be here.
Let's jump in real quick. Tell me about your company. How'd you get started, or the taxes? Let's just start from square one.
Start from square one. All right. So the interesting thing about taxes is it's this thing that affects everybody, right? But nobody teaches it in school, at least not most places. I wasn't taught it in school. So it started intriguing me as a young adult that there was this thing out there that nobody knows about. And I had a few, careers that didn't work out for me. My first one was trying to be an engineer, but anyways, ended up working in the tax industry as a salesperson, and didn't know much about tax, but learned, fast. And so then I got my enrolled agent license so I could practice, because it was very interesting to me, people that had gotten into tax trouble and weren't able to, get out, and they didn't know what legal rights they had. So this led me to go to law school even and study the subject further. And during law school, I had a few clients I had picked up from other tax companies, one that I was working for, that their tax problem was so tough, they didn't think they could handle it. So they gave it to me. And I saved up 2 or 3 people, a couple $1 million. It took several years to do. And I got a nice chunk of that. And that's what allowed me to start this business, which I started in June of 2018. So we've been in business for about 3.5 years, do 21 million in revenue, and just opened another location in Las Vegas. That's where I've been all week, because, new location requires all the effort. So we got 4 locations now: Vegas, OC, downtown LA, and Encino. So it's real exciting.
Wow, that's a lot there. So essentially, you went to law school to study tax and understand it. And what was the inspiration of starting your own firm? Where did that come from? Like, you saw, okay, there was a problem, you were able to solve it for these clients. So you said, I could probably do this better on my own. What was the thinking?
Okay, so twofold. One, I thought I could do it better because the place I was working at was kind of unorganized. And then 2, honestly, because I was working on the sales side, I saw the amount of revenue it was bringing in. And so I was like, wow, because I always wanted to work in finance. But hey, guess what? I didn't go to Harvard or Yale. My family's not connected like that. So, that wasn't an option. So to me, I saw a back door into the financial industry where you could, deal with these kinds of things and actually be an asset, because nobody, even the hedge fund guys, understand it. I've since the very beginning, I have made the analogy that tax is like, if you be is like a doctor who knows brain surgery. You can go to all the doctors in the world. There's only one that's going to be able to perform that surgery, right?
Mm-hmm.
And the tax law industry is like that because it's very specialized, very cottage industry. And so it just intrigues me because you can go to the top 5 accounting firms and all the way down, and tax resolution, which is what I primarily do, tax planning and that kind of thing, it's real niche. It's real niche.
Gotcha. So you're figured out a place in the market that was not set, and you kind of decided, okay, I'm going to focus on this niche part of the market that's relatively sizable, and you're able to build a business. Like how many employees do you have?
About 120 right now.
Wow, that's
Yeah,
awesome.
payroll is crazy.
Payroll tax is crazy.
Yeah, absolutely. Especially out here in California. That's why I'm happy about my Nevada operation.
Yeah.
But no, it's crazy. But it's also about constantly staying up to date, because taxes change every few years with legislation. They change dramatically every 4 to 8 years with when the regime changes, right? So the
Mm-hmm.
last time the tax code changed a lot was in 2017, was the Tax Cuts and Jobs Act, when the Republicans were in control of the Congress. Now that it's the other way around, you know, probably Biden is going to make some changes. He certainly has said he is going to. And he's made some, closed some loopholes, done this, but on a major scale, is he going to change the corporate tax code? Is he going to raise the tax bracket on the highest income earners? Is he going to get rid of certain things like, the step up in basis, or 1031 exchanges? Those are the kind of major ticket items that could happen this year. And so
Gotcha.
on that route is another thing that I have specialized in, which is crypto taxes, because you have to be on your P's and Q's in the tax game. And that is something that I've found a lot of success with as well, because there's a lot of it within the cottage industry that tax is. There's a lot of accountants and that understand maybe the law up to date, but don't understand the whole universe of cryptocurrency. And just incidentally, because I've played around with it for the last 10 years, I do understand it. And so I've picked up a lot of clients in that field, because a lot of these crypto guys have made a lot of money. They're real young and they don't know what to do, how to pay the least amount of taxes, how to report it, how to legally report the least amount, but not get a letter from the IRS saying that their assets are going to be seized. And the reality of the situation is, for 2021 so far, and we're not even over with the year yet, the IRS has seized over $3.5 billion in cryptocurrency. It accounts for 97% of the asset seizures this year were in crypto. So, you got to watch out for that. And so I specialize in that because right now, and that's what Get a Tax Lawyer's actual specialty is right now. We do it all, but we're focusing on crypto heavily, because there's a lot of people out there that are going to get spanked by the IRS if you haven't already been, and we want to keep you protected.
So just because a lot of people are in crypto, and might not know, the ins and outs of the best strategies, and they might make a mistake, right? Selling something too quick or within the wrong year. So from a high level, like 1,000-foot view, what strategy should someone be thinking? Like, hey, I have a $10,000 gain on crypto. Where should their mindset be?
Okay, so here's where your mindset should be with crypto is, first of all, let me just say this. Crypto, by definition, this is a weird tax thing, is not a security like a stock is. It's considered an asset. That's a property. But the only reason that's important is a loophole I'll talk about in a second. In reality, you should be treating it like a security. You have a basis in this, and you're going to pay capital gains or you'll have a capital loss when you sell it. And the whole argument of, well, it's crypto. Do I have to pay taxes on it? Or I have it in a cold wallet. How will they know? Listen, you don't want to play a shell game like that, because that's why the IRS seized so much money this year. And they're hiring 300 more people that they call special crypto agents. That's the title of the position. So the argument of I should be able to hide my money so I don't have to pay for it. Listen, you want to do everything you can to pay the least amount of taxes legally possible. But as soon as you cross that gray line into the black of avoiding taxes, you're committing a felony, and you don't want to do that because they'll take all your money. So what I have to tell people is, yes, you owe taxes on your crypto gains. Don't try to hide that stuff from the government, because you're just setting yourself up for failure. Remember, it's based on blockchain technology. The government is going to be able to backtrack it and figure it out. Even if you got it in a cold wallet forever, fine. It's offline for then. The second you spend it, it's back online. Okay. Yeah. So just keep that in mind. But also, because crypto is not a security, there are certain things avenues that we can use to lower someone's liability. Well, first, let me say this, just as a capital asset, if you hold it for a year, like real estate or any other thing that's a capital asset, you're going to pay long-term capital gains rates on it, as opposed to short-term capital gains if you held it for less than a year. The difference is substantial, because short-term capital gain rates are ordinary income. It's the same thing. That's what you pay on your W-2 or on a 1099. Same rates. Capital gains rates can be as little as 0% if you don't make that much ordinary income, or as high as 20%, which is still about half of the 37% that you could be paying as a maximum tier wage earner. Mm-hmm. So that's true with securities and crypto. What's unique about crypto is, if you have a massive loss on crypto, you can sell that position, buy it back, and use that loss on a different capital gain that you have. Now, usually that would be a short-term capital gain. And so if you have a capital loss, so you could use that on a different position. Now that's the rule that prevents that from happening in the stock exchange is called the wash sale prevention rule. Now, that's been around since 1930 or so. So it's the old rule in the SEC. The reason they put it in there was to prevent what's called tax loss harvesting. That's what we just talked about. Like, you sell it low, buy it back low again, and then take the loss. Yep. But primarily to stop something else that also happens in crypto quite rampantly, which is pump and dump schemes. So the idea in crypto is, like, you on Reddit or somewhere, someone's talking all about this crypto, buy, it's going to go up, right? So that they can sell it when it goes up, because they're already holding a bunch of it. So that's what was happening in the old days of the stock market, when there was basically, the SEC wasn't doing that much regulation on, they were regulating, but there was stuff they still had to figure out. And so what would happen is, they would pump up these penny stocks and then sell them to unsuspecting buyers who saw it go up 10, 20% or more in one day, and say, hey, this thing, I got to get in this. And then, of course, the only reason the stock went up is because what they're doing is just buying and selling it between themselves, but they're a whale so much that it drives the price up. You see? So if you're a whale and you just buy and sell between yourself, you can drive the price up. So that rule was put in place in the 30s to prevent false pump and dump schemes, false price raising by that. Also had the effect of stopping what's called tax loss harvesting, which is where you sell a position when it's low and buy it back again. Why is that disallowed in the SEC? Because you're supposed to have an SEC. So the stock market follows a certain portion of the tax code that is referred to as the corporate tax code. Okay, it's obviously a bunch of other stuff as well, but that's what's called. It's section C in the tax code. Okay, so anyways, the point is there is a super carryover coverall bet in the tax code in section C that says, it's called the economic substance rule, that says basically you can't do anything, you can't have an economic transaction and take a tax benefit on it unless there's some sort of economic risk to you. So if you have if you create a transaction amongst you and a friend or something, so there's no risk. You sell something from a company you own to another company, there's no risk, or you buy a stock within 30 days. Now, they made the period 30 days. You have to buy it and sell it to not go afoul of this rule. Then they disallow the loss because they say there wasn't any economic substance. Now, the reason I brought up section C of the tax code is this has only ever been used in business context, and the SEC picked it up. So since crypto is not currently, buying and selling crypto is not currently governed by the SEC because airdrops, being paid in crypto, and creating coins already is, and that's new. There was a lawsuit just a couple months ago that made that the case, but still the actual regulation of the buying and selling the exchanges like Coinbase, all that, that's not on the SEC, so we don't have that rule. Therefore, we can buy and sell and not have to worry about going afoul of the economic substance rule because it doesn't apply to that section of the tax code.
Yeah. So, yeah, that's a lot of moving parts. Like I hope our audience kind of grasp that. But maybe to summarize it, compared to trading stocks, it's very regulated by the Security Exchange Commission, right? So crypto, it's a lot newer. The technology is moving very quick. That there's no regulation yet, or there might not be, and that's to where you can have a lot of benefits of doing stuff that almost 100 years ago, no longer, or 90 years ago,
has been illegal for the last 100 years because it's that crazy that they would even allow you to do that in the first place. But yes, so you could do it. But here's the thing is Biden has said that he's going to put an end to that. So you can do it this year and you can probably do it next year because they'll probably have to sunset it for a year. But by 2023, I would expect that loophole to be phased out. So take advantage of it now.
Gotcha. Oh, interesting. So, and I think since we're on the, crypto kind of topic, I know maybe you could enlighten us a little bit of how people are kind of taking the NFT world. They take some of the profits. I know there's some type of a strategy. You mind to elaborate on how people can save taxes using NFTs?
Well, okay, so NFTs, they are more complex tax-wise than one might first let on because usually you can't buy them with US dollars, right? So you have to buy NFTs with Ethereum usually, which means you're going to have a capital event, possibly a taxable event when you purchase an NFT because you traded the value in cash in Ethereum or whatever coin you're using for that NFT. And the way the IRS looks at that is you sold that coin. It's not like you just bought something, right? Mm-hmm. So that's a taxable event. So let's say you bought Ethereum at 4,000 and then bought the NFT when Ethereum was worth 200 for 4,200. You'd have that gain in the amount of Ethereum that you sold for that NFT. Then you have the NFT, which right now is treated as a collectible, like a piece of art or like a nice watch or something, where it's expected to go up in value. If it does, you pay a special capital gains rate on that, which is 25%. It's higher than normal capital gains because collectibles in general, it's expected that they go up in value. Like they don't look at it as like you have the same amount of risk as a stock, which is capital gains or crypto. But the crazy thing is people are buying these NFTs real speculatively. So it is like pretty risky, Mm-hmm. And then when you let's say you make a profit, let's say you bought the crypto punk or whatever, one of the good ones, it's going up in value. And so then you make a profit when you sold that NFT for Ethereum again, or whatever. And then again, when you cashed out either to USD or Tether, which a lot of people do because they want the value of the dollar, but they don't necessarily want a dollar,
Gotcha.
So you have 4 taxable events there. So you can use that if you're not paying attention, that can smack you in the butt. But if you can use that to your advantage to create losses, etc.
So hearing what you said, it's like, I mean, it's like a just an NFT, like the four potential taxable events. I mean, question are if you mention to your standard accountant CPA what NFT is, they might not even know. This is all new. Like I just bought an NFT and like it's made $10,000. Where do I go? It's just kind of like your CPA could be 60 years old, and it's just like,
your mom's accountant is not going to understand that, and that's why I have specialized in this kind of stuff, because it's completely new, and it's the kind of, it's not new in a way that like, oh, the law changed, of course. Well, then your mom's accountant would be up to date on that, at least we'd hope. Sometimes the older ones aren't even up to date on the law, but it's because it's a brand new concept, a way of making money that didn't exist even 10 years ago. So it's so new, it's so crazy of an idea for the people. Basically, you got two crowds of people out there. Well, let's say three. You have your regular people who are like kind of intrigued by it. You have your crazy DeFi people like me who are really into it. And then you have the people who just have been ignoring it for the last 10, 15 years. And accountants in general fall into the third category, simply because accountants by nature are very, very risk adverse, right? Because that's what they're supposed to do. And so because that is the case, most of accountants are not going to be up to date on things that the IRS is still trying to figure out how to tax, right? They're not going to feel comfortable doing that, because now, this isn't everybody, but typically accountants are very, very risk adverse, which is good usually, because you don't want your accountant taking risks, right? Now, that's the difference between a tax attorney like me. An accountant is a tax attorney. We like pushing the envelope. We want to see the code so we can find the loophole and take advantage of the system. Because I was just looking at this law that got changed. Basically, it got put into action this week. And they were talking about it's going to be put in so next year. And basically what it is, it's the hold on, I have it up on my computer.
And while you look that up, I just want to say for our audience, like you might be, because I know a lot of people were very successful over the past 2 years with whether stocks or NFTs or crypto. I mean, you might have, be 20 years old and you just, you have a $50,000 gain, which was unheard of, years ago, to make $50,000 just, from your cell phone doing that. But, you do have to make sure you're, like, these are federal laws. Like, catching a felony is a very, very serious issue. You can't just be like, oh, it says on my Robinhood I made $50,000, whatever. Like, no, you have to reach out to someone who's a professional and understands these laws, because you can get in trouble if you don't.
That is 100% true, because I would say on my TikTok, I see people comment very cavalierly, and it's like, listen, even if you're doing that, please don't comment on the TikTok, because you're telling on yourself. You're like, oh, I'm not paying taxes, or I made 200 grand and the IRS doesn't know about it. Well, why would you type that in somewhere? Because now you're admitting it, right? The point is we live in the information age. Data is bought and sold by everybody, including the government, and everything you do is recorded. So, you just got to accept that as a reality, and don't do anything that's going to, screw you in the long run. Anyway, so the act I was looking up, it's called the Corporate Transparency Act. It was actually ruled into law by Congress several years ago, but now they're finally deciding to activate it. And basically what it does is it eliminates shell corporations unless you are able to break a certain loophole, which I'll explain in a minute. But the idea is right now, before this law gets taken into action, right now, it's very easy to, if you know what you're doing, set up several entities that are chains of each other. And like by the end of it, and this is a common strategy for more of asset protection than tax avoidance, but they kind of overlap. We do that too as well, by the way. Um, but it's the idea that I can have one entity own another entity that owns another entity, and by the time you get to the end of the chain, nobody knows who owns anything, right? Mm-hmm. So that's called the shell game in the corporate world. So to have a shell game, shell companies, shell corporations are basically making it illegal now. What that means is that every company will have to have a real social security number person that is associated with it. Now, the one loophole that they left in the system, and you gotta love the government, is if you're making more than $5 million in the parent company, you can have subsidiaries that don't have an owner. So again, like most things,
Gotcha.
They have cut out of the tax code a spot for the wealthy, right? So, and hey, listen, if in the corporate world and in business, it's revenue too. So 5 million in revenue, that's a lot of the middle class can benefit from that.
Yeah. Yeah, and just because, like, I know we jumped right into crypto, but kind of to bringing it back a little bit, say I am just your average, I go to work hard, I like my country, I pay my taxes. What can I do? I make say $50,000 to $80,000. What can I do? Or how should my thinking change, so to speak, like macro?
Right. Okay. So I do get this question a lot, and so my response to that is the first thing is, how are you paid? Because whether you're paid on a W-2 or your independent contractor on a 1099, it's going to make all the difference in the world. The difference being that when you work on a W-2, your employer takes your taxes out of your paycheck. That's why you work for a set amount, but you only receive, a net amount smaller than that, because your taxes for both your state and the federal are taken out by your employer. It's called payroll tax. Now, when you're on a 1099, you pay your own taxes, including self-employment tax, which makes up for the payroll tax mathematically.
And a 1099 meaning like an independent contractor, you don't work for somebody.
So when you're a 1099, that means you are either an independent contractor or a small business owner. Either you work for somebody in a capacity like Uber Eats or something like that, where it's like, or you're a painter, where you have many different employers all the time, and you're a contractor, or you have a business and you're running a business. So we're talking about more and more than people every year are quitting their jobs and starting businesses. So this applies to more people every year. But let's say you're on the W-2 side of the fence, because if you're on the 1099 side of the fence, you can write off pretty much everything. What if you have a job? Well, problem is the government has decided through the standard deduction, that's what they want you to get. So the only way out of that mess is to start a side hustle. Start a side hustle, because if you're losing money every other year, as long as you can post a profit every other year, you can claim that whatever you're doing is a business, right? So let's say people play cards or something and they lose money, and they want to write that off. Well, you can't write off your gambling losses unless you can prove that you make money every other year. No matter what you're doing, if you can prove that it's profitable, you can call it a business. So,
Gotcha.
So let's say you work for a W-2, but you have a passion in collecting sneakers or something and you like to sell them. Well, do that, because then when you have costs, you can write off, and expenses, you can write off your W-2 income against that. And that's the only way to get W-2 income down, besides things like, well, of course, contribute the most to your retirement account. We'll do the same thing. You can buy certain bonds that would make your income not taxable. But the reason I say that is because most people are like, well, how can I save the most amount of money now from taxes? And what that comes down to is you want to start unless you have a serious 401k that you're contributing to, which also isn't a bad thing, but you're going to start a side hustle, because those are the two ways that you can eliminate W-2 tax debt. Otherwise, you're pretty much stuck with it.
And to recap, punching in, punching out, W-2 meaning you work as an employee, it puts you in this small box, and there's not many options. But if there's something that, you know, you do maybe training for something, or you do online business, you can really hone in on the benefits that the government has out there for you to take advantage of. But without that business or side hustle, you're really stuck on what you can do within the W-2 framework.
Exactly, because it's and it's kind of a shame, but because your taxes are already taken out, and really what it comes down to is the government doesn't want the average employed worker, making these kinds of decisions. But the reality of the situation is more and more people are quitting their job every year. Right now are in the what's called I forgot the term they were using. It's like the great resigning.
The mass exodus or something. Yeah, or resignation. Yeah, that's been a common term.
Mass resignation, whatever it is. 4 million people a month are quitting their job, and they have to make money somehow. And so a lot of them are starting their own businesses. So whether or not that's you, or you're having a W-2 income, that having that side business, which is easy to accumulate losses. And of course, when you have a business, you can literally write off anything, your car, all that stuff. It makes it so you can get rid of some of that tax. Now, you can't do it every year, like I said, because you're gonna have to post a profit some years. Otherwise, the IRS will declare what you're doing a hobby, and then you can only write off the amount that you spent. Like gambling is a good example. So, or hunting. People like to gamble and hunt and for prize money, right? Excuse me. If you won the tournament and you have all this money, that doesn't mean that now you can call it a business and deduct all the losses you had. To do that, that's why the IRS says you have to be profitable every other year. Their exact words are 3 out of 5 years. So if you do the math, that's every other year. Because then it's saying that it's a legitimate business operation, because you don't want to have your Schedule C losses disallowed by the IRS because they said it's just a hobby because you never made any money.
Gotcha. And then do they mean make a profit as in bring in revenue? Or actually you have to have a net profit on that side hustle?
You're going to have at least a net profit on that side hustle of at least $1 every other year. If you make $1, that's profit. But gotcha. net, yeah.
Net profit, not revenue, net, bottom line. Okay, interesting. That's very good to know.
Yeah, so every other year can really help you out. And then hopefully your side hustle is bringing in money. So then you got 2 sources of income. You hear the financial gurus, what do they always say? It's always about multiple sources of income, to make money.
Now I heard like a lot of people might say like different sources of income, kind of change your strategy, but also like with real estate, I don't think it's really I feel like it's talked about a little bit more since like the real estate market's getting hot, but like, aren't there a lot of tax benefits with the real estate?
100%. So real estate is very interesting because it's a quite protected area in the tax code. We have all sorts of things. There's the 1031 exchange, which would allow you to sell an investment property and buy a new one and defer your taxes technically indefinitely, as long as you keep purchasing properties. Now, the limitation on that is you can't do it with your personal property. Now, but with your personal property, you have homestead exemptions, both on the state and federal level, which could alleviate you from capital gains when you sell that, as well as, and for most states, it's as high as $500,000 or more. And then one of the most fantastic things that allow for intergenerational wealth exchange without taxes is what's called the step up in basis. Now, Biden has said he wants to get rid of pretty much damn near all of those things, but that's in the last 100 years, they have tried to get rid of it once or twice, and it's just not feasible because it hurts the middle class more than it hurts the upper class.
So I'm going to ask another question here. Like, what are your thoughts? You've been kind of hearing this rhetoric. It's kind of increasing, especially since pandemic, like taxing the rich, like rich. That's a sensitive topic for many people. Like, what are your thoughts on that as a tax attorney?
Okay, so it's the real problem isn't the rich per se, it's the uber wealthy. Let's say the people on the Fortune 500 list, for example, Jeff Bezos, Elon Musk, really billionaires, like rich people that are, tens of millions, hundreds of millions of dollars. A lot of these people are paying more taxes than you or me because they make more money than you and me. The problem is these people that are billionaires, they don't keep their money in cash. The reason they became a billionaire is they had, like, let's say Mark Zuckerberg, for example, he formed Facebook and then sold it and it went public, and his shares that he has probably millions of became worth thousands of dollars. And so suddenly he's a billionaire on paper, not actually having $1 billion in his bank account. So because he hasn't actually realized any of that gain, because he hasn't sold any of the stock, Jeff Bezos, Elon Musk, that's how they're able to not pay any taxes and still be a billionaire. Now, is that totally true that they're not paying any taxes? No, they're just not paying any taxes on all that gain because they haven't sold the stock yet. Now, Elon Musk recently tweeted that that he was going to sell some stocks because he wanted to pay taxes. Okay, sounds like a real charitable move, but from the guy, right? But in reality, he had to execute an option that he has for his company this year to make $135 million more. And to do that and have the money to pay the taxes on that, he had to sell some of his stocks because he doesn't keep that much cash. So these people only sell enough stock that they need to survive and buy the things they want, and they keep the rest of their money in a complex options, so that if the stock market tanks or goes up too far, it would operate a buy and a sell so that they're protected from a market crash. But other than that, they're keeping their money in the stock market.
Gotcha. Wow.
And that's why they're not paying taxes, because it's unrealized gains. And you're only taxed on gains once you actually realize the money, once you sell the stock. Because technically right now, the stock price of Amazon could go down, right? And so because there is that economic risk, remember we talked about that before, that's what makes it a legit non-taxable event. Well, it's no event occurred according to the tax code because it's still sitting there in a risk asset, basically. So because it's subject to risk, it's not taxable until you actually cash out and trade it for something else or use that E-Trade debit card or whatever, right? So so to answer your general question, do the wealthy pay their fair share in taxes? Most wealthy people do, yes, because they're not like that. So they're stuck paying the highest tax bracket and the highest rate in capital gains. And also a lot of affluent people put their money in corporations to pay less taxes. That's legit. But I do that. That's something I sell and do myself. So if you're making too much money and need to pay less in taxes, the name of the game is to get in a corporation, because the corporate tax code is 21% corporate tax rate. And it doesn't matter if it's capital gains, ordinary income, $1 million, $1 billion, it's a flat tax rate. So it's interesting because that's the one thing that everybody wants in this country, but the government won't do for personal tax, which is a flat tax rate. You got a corporation, you have one. So that is how the wealthy avoid paying taxes legally. And I would say as a chunk, if you look at the bottom 50% of income earning taxpayers, or lack thereof, in this country pay 0% in taxes. The next 40%, the middle class, pays about equal that what the top 20% does. So in terms of on a macro scale, the rich pay more taxes than anybody else. But on a smaller scale, the uber wealthy are able to completely skirt the system.
And to reiterate, you said 50% of United States citizens
pay nothing in taxes. It's over 50%. It's probably
Over-
closer to six.
Wow.
Probably
That's-
closer to 60%.
That's considering like older people, unemployed, like children. That's everybody. The 300 plus million.
Okay.
Yep, that's everybody, but that's including people that like say are on Social Security that cost money, right? We pay our taxes for Social Security. They don't pay taxes on that, obviously. It's just a government dole. That is the single biggest line item of the government right now. So if we were talking 20 years ago and it was 2001, September 11th had just happened, the biggest line item of the government was defense.
Mhm.
Like we spent over $1 trillion a year on defense. We now spend maybe about 700 billion on defense and 1.2 trillion on Social Security.
1.2 trillion into Social Security.
Yeah, this year. So it's the biggest line item that the government has to pay for. And that may not be true once we find out how much, the government has given away in stimulus checks. But because that was $2 trillion as well.
Ooh, wow.
So especially for a country like the United States, which prides itself on being this capitalistic place, it's been a lot of free money from the government, which is socialism. Just saying,
Yeah. Yeah. Hey.
Dude, I mean, it's an observation, and I feel like things are changing.
Exactly.
Better, worse, we'll see.
We'll see. It's interesting to me. Before I went to law school, I studied political science as well. So I like to follow that kind of thing because there's all of these isms that people are scared of, right? Like socialism, capitalism, communism, but they're ideals. They don't actually exist in pure form in real life.
Yeah.
You can't have a situation that's purely capitalistic, purely socialistic. You need a mixture of the both. So when people usually claim something is this or that, the reality situation is what they really mean is it's exhibiting symptoms of a system like that. But an economic system in reality never really can exist as a pure system. Look at China. It calls itself the People's Republic of China, but they are very capitalistic at the same time, right? So it's like, look at Germany, right? Germany, World War II, fascist regime. Capitalism was important there. Socialism was important there for some people. But it's like you just really can't have a regime without having a mixture of everything, because basically when you have a nation of people, the state, what makes the state legitimate is that they can maintain a monopoly of violence over the people. What that means is here in America, if the police shoot you, it's all good. If the army shoots you, it's all good. If I shoot you, I'm going to jail, right? Because I'm not part of the government. So in a nutshell. And so that's why it's important that these different powers that the government has, of course, there's going to be aspects of it that are socialist. Of course, there's going to be aspects of it that are capitalist. And of course, there's going to be aspects of it that appear to be communistic. But communism is the one that like really doesn't really ever exist. It's kind of an idea.
Mhm.
But shout out to Karl Marx. Das Kapital is the best on capitalism I've read.
Cool. Yeah. Tyler, man, this is, like I said offline, like I want to do definitely another podcast. I feel like we could go so deep on many more tax strategies and ideas. And
Absolutely. I love this kind of thing. So it's just what I love to do. Talk about, it's my passion, taxes and business and finance in general,
So
and history.
Yeah, no doubt. And someone has wants to get a hold of you. It's like, hey, dude, Tyler sounds like a good tax accountant, or I need questions. Like, where do they go? Who do they call? How do they get a hold of you?
You go to the website, getataxlawyer.com. I don't know if you're going to post a URL or whatever, but that's where you go. It's very easy. Getataxlawyer.com. And right there, you can either give my office a call or schedule an appointment and someone will get back to you. And you can also, if you want to talk to me directly, you can schedule an appointment to talk to me.
Cool. Tyler, dude, I appreciate you coming on. Very exciting. I yeah, I learned a lot. Looking forward to our next one, hopefully soon. And yeah, thank you, brother.
All right. You have a great evening.
I hope you enjoyed that episode with Tyler. I really got a lot out of it. Just some final thoughts in conclusion. One cool thing, I mean, Tyler was very excited about was in the crypto space and kind of the different things you can do in the crypto space that would save on taxes. I mean, the tax loss harvesting where you can sell a stock. I thought that was very interesting. You can't do that in the stock market. In some sense you can, but there's more rules regarding what the SEC and things like that. But in as you heard him describe, in crypto, there's not as many rules. Also, another thing he mentioned was, if you have these gains in crypto, you need to report them because you never want to mess with the IRS. I'm not a CPA, I'm not a tax advisor, but what you want to make sure is to not pay the IRS. That's very important. So that's one thing that he mentioned. Also, I thought it was very cool how he talked about a variety of different options to, if you have a 9 to 5, what you can do if you have like a side hustle, as in maybe if you drive Uber or maybe if you have a side business. Those benefits of being it's called like a 1099, you can write off maybe other things that you're already paying for, maybe your phone bill, maybe your internet, possibly your part of your rent. So that was pretty cool how I learned how that is an option. I mean, if you guys want to learn more about taxes, I would suggest reaching out to Tyler and his team or a CPA and just ask these basic questions. It's super important. Like, hey, how can I save taxes? It's not just at the end of the year, checking the box, this is return, this return. It's strategizing, thinking. I found that really interesting when talking to Tyler on and off camera. He was super knowledgeable. He knows the tax code through and through. So this was a very exciting episode for me, and I hope it was for you as well. Hey, make sure to like, subscribe, comment. Let me know what you think about this episode. Should I have Tyler back on? I'd love to have him back on. I learned so much. So let me know. Thank you so much.